Good morning, ladies and gentlemen. Let's review a week in which very little happened because there was very little data, but in which signs that duration is just for sale increased. It's always in times like this when nothing seems to be happening that you can see what the real trends in the market are, and they're not good. 2-year note did absolutely nothing, stayed in a very, very tight range, and I keep on saying that the 2-year note is likely to be a very dead contract in both Germany and the US for quite a while. Next week we have CPI and PPI, and a lot of people are getting excited about that, but when you think about it, what can CPI and PPI do? They can either prove that Powell is right in being reticent to lower rates now, in which case, how far up do we go in the 2-year note? Well, I would be very, very surprised if we go higher than 405. It's very, very unlikely that the market is going to give up on the idea that the next Fed chair in May is going to be anything but extremely dovish, which basically means that the 2-year note can only move about 10 basis points maximum to the upside, because there'll be a whole load of buyers up there. They can do the math as well as I can, and that shows that if you expect cuts from May onwards next year, even if you don't get any cuts now, you are really, it does pay to buy the 2-year note in this area, even if you expect no cuts this year. And I'm quite sure that we will get one cut at least this year, if not the two that the FOMC projected. I think there is a zero possibility of cuts happening in July, but I think from September onwards there's a decent chance of at least one cut, and therefore the 2-year note is going to be continuously bid. Now, we had the 10-year and the 30-year auctions, and anybody who bought those is now underwater. This is where the 10-year auction went off, around right here, and they had a day in which to get out at a very small profit of 2-3 basis points, and then boom, on no data, on nothing, we go higher. The way this chart is set up, to me, says that at some stage we trade 458 in the tens and even higher. Duration is just for sale. But the really bad one is the 30-year. The 30-year auction went off here. They had a day and a bit to get out, and straight back up to the highs that we'd been at for the past 3 weeks. This to me is extremely dangerous, an extremely dangerous chart, and especially if you start looking at what it looks like on the weeklies or the monthlies. This is the weekly chart. If you say that this is some sort of a flag that we've broken up, we've got no support till the highs at 511, and if I then try to reset this price scale, you can see that we really have the possibility of, over the next few weeks, spiking all the way up to 5.25 and 539. 539 is something that we have not seen since basically 2002, and the real danger here is one of steepening. It's just steepening. Having any other position that's then steepness, to me, is really asking for it. So we have 2s, 5s, and we'll go back to a daily chart. You can see how dangerous it is here to look for a flattening in 2s, 5s. If we look at 2s, 10s, we really can't get up above minus 42, and the 200-day moving average is rapidly approaching it. I think over the course of the next 1 or 2 months, we will definitely have a spike in duration in the longer yields, while the 2-year note, as I showed you, does almost nothing, 10 basis points up or down. And if we look at 2s, 30s, I mean, it's just been in this range since April, and it's a 15 basis point range, and it can't do any better. And where is real support? Well, you can see that when this thing gets going, it goes. And the real support to me is down here, minus 226. That's another 120 basis points of steepening. Why would this steepening happen? I mean, this is a huge move. Well, it would happen because real rates are going up. This is as long a chart of 30-year reals that I've been able to find, and it's quite frightening because now we are above all the levels that we have seen since basically the GFC. So this is 2008, this is 2006. Whenever you think the GFC happened, it happened somewhere around there. And then we had the big trend down to zero or even negative in real rates. And now we are at the highest we've seen since the GFC. And we came from roughly 340. Now, an 80 basis point increase in real rates, you have to calculate that some of it will be term premium and so on, is roughly 100 basis points move in nominals, roughly, I would say. So you're looking for nominals to be able to go up another 100 basis points from here. So you're talking the high fives in 30 years. That is amazingly destructive for the economy. And while this keeps on happening and it keeps on telling you that real rates are not high enough, that means that everything is for sale. The curve is steepening, and it's very dangerous to be very long of high beta assets. It is what it is. I personally think that we are going to have an accident, that we are going to go to the 3s, 310, 320 in terms of 30-year reals. That the real problem is in the 30-year real rates. It's not in the 10-year. The 10-year is much more contained than the 30-year, but the 30-year is the one that prices all these equities, the mortgages. It could really start getting quite ugly very quickly. And it's one of those things that I really can't see how you tackle out of it. It's what do? Do you cut rates? How is that going to help? That's going to make people think that inflation is going to be even worse. It's going to get people to sell the dollar. I just can't see how they remedy a situation of high long-term real rates. And people keep on saying that there aren't any bond vigilantes left. Well, this is a bond vigilante, isn't it? Taking real yields above all the levels they've been since the GFC, how is that not being a bond vigilante? I also keep on looking at this chart of 10s, 30s, and it just tells me that until and unless we get down here, and that is another 25 basis points, it's really not going to find an enormous amount of support. It might, it's finding the support right here where I said it would, but it's weak, right? It's every time it bounces, it comes back. It bounces, it comes back. It's just sitting there. There's zero impulsion back up. People cover, the traders cover. They trade from level to level. They cover. They're sitting around. It's summer. Nobody's doing anything. But as soon as things pick up, it's going to go back down to here, which tells you that term premia are going to rise because 10s, 30s is should be almost pure term premia. And if term premia are rising, they're pushing up real rates. It all tells me that we are more likely than not to get an accident in the 30s. And so let's have a look again at the 30s on a daily. Is it going to happen next week? Unlikely that it happens next week, but it's still going to push towards 511 at some stage. Now, as you know, I've been talking about the QRA, which is on the 30th of July. I doubt that we bust it by then, and we might get a great opportunity because if the QRA changes, okay, we buy some calls, we are here, we get some calls, great, they change the QRA, we go straight back down to 470. But longer term, this just looks so dangerous because we are having almost a Minsky moment in which the market just says, I've just had it with US duration. And then you're talking about a world of hurt for everything. You're talking about, 330, 325 real rates. That's a killer. And that will be the time to buy duration and also to buy all assets, because all assets do much better once real rates have topped. And real rates are showing you that they have not topped as yet. And if you look at the MOVE index, right, it's as low as it's been for, years and years and years, since basically COVID. This is going to give us some wonderful opportunities because there's absolutely no point in having outright positions anymore because volatility is relatively cheap. So we can just have option positions which give us just as much upside as outrights at a fairly cheap price. And finally, I wanted to show you a chart of TLT and actually go back and show you a weekly chart. And this is without dividends. And as you can see, the low that it's ever traded that people can remember, apart from me, because I'm so old, is about just above 80, 50, something like that, 80, 70. Now, you're not going to tell me that this market isn't going to try and spike these levels and get everybody absolutely buried. I think it will. And I think that being long of duration at the moment is the silliest thing one can do, because even if CPI and PPI are decent, the fact that real rates are still rising, the fact that term premia are still rising, the fact that everything that I look at tells me that they're going to keep going that way, means that the upside for now in TLT and the longer duration contracts is very, very limited. So why bother playing? We will know when it's time to buy duration, because real rates will have hit something that the economy just can't take anymore. And it's not as if the rise in long-term rates, i.e. the 30s, is something that's confined to the US. The US is the one where the problem should be the worst, and this is Germany 30-year, and as you can see, we are right at the top of the trading range for the whole year. Let's go back. We are where we were right here, right in the UK. We all know, I'm not even going to show you the UK because we surpassed these levels, but I'm just trying to show you how this seems to be a worldwide phenomenon. And the US should be the worst. And that's what tells me that we are very, very likely to get accidents in the US. Now, this level here seems to be very, very interesting. And this is 353, as you can see in Germany. So if Germany has another 30 basis points to go, why would the US not do exactly the same? you can see where I'm coming from. Just don't be long of duration. Either be short of it or flat. Either have a steepener on or flat. These markets are headed for an accident, because when duration spikes and real rates spike, everything then has a problem. I also wanted to show you a chart of 10s, 30s in Germany, and as you can see, a lot of the time, since all the way from 2000 on, it's spent in this range between, 80 and 60, let's call it. So a 20 basis point range. Would it not be normal for it to go back there? And that's another proof of a continuation of the steepening, a continuation of the accident potential of 30s. Be very, very careful over the next few months about owning duration. That everything is saying real rates are going to spike to a level. I don't know why they're going to spike to some level, which is probably in the US somewhere around 3%. Or even higher, but everything, all the charts are saying that is a distinct possibility, nay, a probability. So the dollar did exactly what I thought it would do last week, and I still think it has potential to this 98.80 level. We are quite likely to see it, but it doesn't really make much difference, or it's quite meaningless for the time being. So let's have a look on the weeklies. I told you that this 96.47 level is really, really important, and only if it goes through there do I expect an acceleration of the downtrend of the dollar. It bounced nearly to the tick, and now we are going to test these levels here. Which, just above 98.80, could we get to 99.30? Yes, sure, but I don't think it's going to go much more than that. 99.20 would be the level that I would be quite happy to start getting short of dollars again. I think it's just trading. I don't think it has any meaning, and I think that the trend over the course of the next few weeks, let's say months, is still going to be to retest the 96.47 and then finally break it at some stage and go significantly lower, probably another 8-10%. But I think in the meantime, we retest these levels up here. The first one on the dailies to me is 98.80, and I think you can actually be long of dollars until 98.80. And from 98.80 to 99.30, you start getting short of them. I think it's really as simple as that. It's a trading market, and every reaction that you get now from the dollar on tariff news is actually to buy the dollar rather than sell it. People got too short too quickly, and that's what you're getting as a result. I guess when institutions are very wary of buying duration and therefore risk assets because they fear an accident in duration could lead to a depression in risk assets, temporary or whichever, they start buying Bitcoin because gold is in a range and Bitcoin is trading higher. So where is Bitcoin going to go? I don't think it's going to go much higher for the time being. I think it's probably going to retrace, but I think it's going to get everybody long above 121, and then it's going to come back to 106, and then it's going to go up again. It's still in an uptrend, an immediate uptrend. What I don't like is the fact that MSTR is just not leading, and the relationship between MSTR and BTC and the MSTR and IBIT is very, very, very steady, and that tells me that there is no huge appetite for the stock of MSTR, and therefore I'm weary of being extremely bullish of crypto here, because MSTR, every time there was a big move up in the BTC, it was led by MSTR. And you can see on the dailies that we are actually in a very, very tight range of MSTR over the 1.5 IBIT. So the fact that that is just trading around and not leading, this should be going up a lot faster. That tells me that you're not going to see, $10,000 moves in BTC. You're going to see longs and traps and coming back. This to me is go up, get people bullish, come back down, go back up, come back down. I think it's going to be more of a range trade and a stop out trade rather than a continuous move into the 130s, 140s. And even if you look at MSTR, it could easily take out these highs at 450 and then come straight back down to 400. To me, this is not the stuff of which immediate trends are made. I think it's going to be an interesting week to see what GSG does. I like GSG, but as you can see, it keeps on failing. And next week, if we start going down, it'll show you that it's still not ready to go up. I try to zoom out when uncertain. And, I really do think that it's going to go up, and it's going to go up a lot, but it just doesn't look like it's ready to do it now. I think that every time it comes down to 22 and 2150, I will buy it. And then if it starts breaking through the 200-week moving average and 2070, then I am wrong. But for the time being, I think the low is somewhere in this region, just below 22. I am long at 22, and I'm going to stay long. I honestly think that it's going to go much, much higher at some stage, and my objective would be somewhere around here, 33. So, I have a decent risk reward in being long at these levels, and with a stop below the 2070 area. Let's see how it runs. There seems to be no reason to be short of gold, but also there seems to be no reason to be long of it. I keep on thinking, what will gold do if duration spikes? Well, it should come down, but probably it won't, because it'll be seen as some sort of safe haven, and it's where it is. So gold tip hasn't been in a downtrend like it should have been, and all I can think of is that it will remain in a range, and then when real rates have gone high enough, that's probably when real rates start going down, and probably gold can start its uptrend again. But for the time being, I just don't see why you would be very bullish of gold, because until you get this spike in real rates, I just don't see why you would buy any asset at all. Honestly, I don't know what to make of equities at these levels, simply because we are going into earnings season, but also as I explained to you, am very afraid of a spike in duration, and that should affect the price. Now, volatility is extremely cheap, and I've bought some put spreads, and what the hell. Now, what I do know is that the technicals tell me that this is nothing but trading around until and unless we start breaking 61.44, which is important on the dailies and on the 195-minute charts. On the weeklies, it's really nothing until 61.14. And on the monthly, it's really a nothing until 60/40. So we are 200 points away from real support, and that is what, 3-4%, right? 3.5, whatever the hell it is, which could happen in a day, right? Because if you start getting spikes in duration of 15 to 20 basis points in the 30-year bond, you will definitely get a 2%er or a 3%er in equities. So those are my levels. Do I want to be long up here? I think the risk reward of being long up here is not great. But on the other hand, volatility is so cheap that if you want to be long of equities, or you need to be long of equities, do some substitution. Just do some call substitution. Sell your equities and buy calls against it, right? Unless you have particular names that you want to be long of. I don't particularly do at the moment. And apart from being long of ETA and being long of some XLI, I don't really have a reason to be particularly long of anything up here. And I'd much rather own calls rather than the index, and I'd much rather own some put spreads than own anything, because I think because my view is that you get this spike in duration. But on the other hand, am I going to make more money by being long of put spreads in SPX, or I'm going to make more money being long of put spreads in the 30-year bond? I think that bonds are going to lead, and therefore I'd much rather play in bonds and be short of those at levels, or just buy put spreads, rather than sort of trying to pick the exact top in SPX. It doesn't pay. I just know what my buy levels are, and they're not really until we get the test of the monthly. Between 60/40 and 61/14, I think it's the reasonable level to think that equities can bounce. Everything else is just trading. I still continue to prefer NDX as a trading vehicle, simply because the levels are even clearer here. Until and unless we bust 22,115, there is absolutely nothing wrong with SPX. With nothing wrong with NDX. And these levels correspond on the weeklies and on the dailies and on the 195 minutes. And that is why I have more confidence in trading NDX than I have SPX. I think that at some stage we test it, but I think that we bounce like crazy off it. And that would probably indicate to me that we're going to have some decent earnings out of the tech sector, and that the tech sector is going to be much less worried by the tariff tension that Trump keeps on injecting into the market. It's a digital world. Things can be transmitted. These are services, they're not goods. And therefore they should be less impacted by all this talk. But on the other hand, they should be more impacted by duration. So I am weary and I am in two minds, but I still think that I'm going to allow the technicals to tell me exactly what is going on and why. I definitely want to be a buyer of call spreads here, and let's see what happens. One last thing, and that is volatility. VIX is amazingly unstressed. Okay, so I have absolutely no reason to be bearish of equities, apart from the fact that I think duration is going to spike. And that tells me that I should be playing in bonds rather than equities. But really, VIX is going to be signaling that we are having a problem in equities only if it starts going above this range, which is 2280 to 2060. Until that happens, it's all normal trading. So overnight and Monday morning, if you just see a 30-40 point fall in SPX because of the latest Trump letter that goes out to the EU or whoever, that is just normal trading. unless we start breaking these ranges. I mean, I start getting worried at 2060 and I get really worried above 2280. Until that happens and we close above those levels, I'm really not immediately worried about the stock market at all. Next week, we actually do have some data. We have the PPI, the CPI, and the retail sales. So we should get a fuller picture of what the US economy is doing. I don't see how PPI and CPI are going to be any lower than the market is expecting. I think they're going to be in line or maybe slightly hotter. But I don't think it's going to be a number which is going to move the decision of the Fed towards the July meeting. It would have to be very low, and nothing really has moved that much, i.e. in terms of oil or whatever, that this CPI should be that much lower than expectations. So I can only see it being in line, in which case, why would the Fed change its mind with an inline number? The unemployment numbers keep on coming out as expected, and we've been told repeatedly by the Fed that only if unemployment starts accelerating upwards will they start cutting before they've seen the effect of tariffs on inflation. We haven't seen that, and we won't have seen it in this CPI because the tariffs go into effect on August 1st, right? So I just don't see what people are getting so excited about, and I don't think that this is going to be the week that the Fed finally decides to cut rates because inflation hasn't gone up. Well, it's rubbish. Inflation hasn't gone up because it hasn't had time to go up. We haven't had the price pass-throughs as yet, and therefore that is just a rubbish argument. I keep on thinking that the yield curve will steepen, and I keep on looking for levels to trade short the 10s and 30s while holding some 2s against it or not holding 2s against it. But that is all I want to do in the bond market. Look for steeper curves and sell bonds, and when vol comes down, buy put spreads. And that's at the long end, naturally. And that's all I really want to do for the time being. In equities, I'm not really that bothered because they seem to be trading with DXY. And as DXY corrects, equities can't go up. So the relationship is one between DXY and SPX. As the dollar goes up, SPX weakens slightly, which basically means that SPX is going nowhere for the time being, and I prefer to trade the bonds. That's all I've got for you. I will tweet you tomorrow.